Hello student, welcome back to Indian Business School. Now we will discuss about the FIFO. I have already explained initially our cost is high, okay, as on when time will pass, okay, their cost will be keep on increasing. This is the price. Every unit when we are selling, we are charging this price, and as soon as we are increasing our quantity, okay, our price is also keep on increasing. Okay, so till now maybe we have charged this is 10, this is 0, this quantity maybe 10,000 k, we sold 10,000 k item, till we are charging 10 k per item. Okay, as soon as we increase by till this maybe 120. Okay, so till 120 our cost may be 12. So 10 to 12, this is the highest cost this is the highest cost we will be keeping in our inventory, and this is the cost we are keeping into our cost of goods. So obviously in your income statement, revenue, whatever amount it is, then cost of goods be the lowest cost, and so your gross profit would be obviously high. So this is the drawback of your FIFO method. Okay, in the case of inflation, obviously your price will be increasing. In case of deflation, maybe price is getting down, that time your gross profit will be lower. Okay, but normally most of the country are suffering or having inflation. Okay, tax implication, FIFO is not restricted by IRS, okay, for income tax purpose. Okay, however LIFO is restricted by IFRS, but not restricted by US GAAP. The US GAAP, no restriction for any of the method. Now if you talk about LIFO method, so you can see that this part is our ending inventory. This is also drawback, right? Because till then maybe we have 20,000 K inventory. Okay, these are the latest inventory which we are purchasing, so their cost is also high. So there may be the cost is 10, there may be the cost is 15. So above 10 we are charging to our revenue, whatever the amount cost of goods we are charging above 10. Okay, till 15 we have charged in our cost of goods. So obviously your gross profit would be what? Would be less, okay, or lower if you charge high cost of goods, and your inventory would be lowest price. Okay, not fair value. This is kind of a stuff. So this inventory will be having the oldest price will be available, oldest price multiply by your quantity we are having, then the value of inventory will come, that will be the very lowest or minimum price will be there in our balance sheet. So that is also not the fair representation. Okay, let's read it out. Most recently purchased item are sold first, so these are the most recently purchased, this will be considered first. So this cost will be applied with the quantity all the time when you sold any of the inventory. Okay, ending inventory composed of the oldest and cheapest item, and these are the oldest time perspective and cheapest. Okay, in rising price, when price is increasing, ending inventory will be showing the lowest balance as I told you. Okay, and cheaper unit price. Okay, cost of goods will be higher and more expensive unit. Okay, resulting the lower profit, your profit will be low. For tax point of view, inventory value recorded at the older and historical cost, and cost of goods value at the current cost. Okay, replacement cost. Okay, so basically they are trying to say this is your current cost, so that cost is going to reflect into your income statement. That is the point here is in income statement reflect the current cost of goods. Okay, they're not worrying about the balance remaining, what is their price and what is their quantity. In your income statement they are trying to say the fair value of current market price of that particular product, that is what we are charging our income statement. Okay, so our gross profit is more accurate. Okay, so this is the overall another way of thinking the same concept. Okay, US accounting and tax regulation, LIFO, and tax used in primary for tax benefit lower the taxable income. So normally we use this method to reduce our gross profit in case of inflation, price is increasing. Okay, so we are using this method so that our gross profit will be lower side and we can get tax relief. Okay, you got me right. Gross profit is 1000 k then, and tax rate is 40%. Okay, so you have to pay 40,000 k. If you use this LIFO method and your gross profit is coming 60 k, then 40% would be 24,000 k you have to pay. So you will be saving a huge amount. Okay, now your net profit may be 60, now your gross profit is 36. Okay, but this 36 is just based on the accounting method. Okay, but what exactly the profit is, we cannot say, because neither this one is correct or neither this one is correct. Because if you use LIFO, they have also their demerit. If you use LIFO, they FIFO, they also have their drawback and their benefit. Okay, so both the method has this kind of issue. So to resolve this kind of issue, company and government has bring another method that is called weighted average. Okay, and this point I have not discussed. International reporting, IFRS do not permit to use LIFO. So IFRS has restricted this LIFO method, but US GAAP has allowed this kind of method. Okay, so I think I'm done for the day. See you into the next session.